A credit score is a three-digit number, typically between 300 and 850, representing an individual's creditworthiness. It's based on data from credit reports and helps lenders evaluate the risk of lending money. Key components of a credit score include payment history, 35%, which reflects timely payments and has the greatest influence, amounts owed, 30%, indicating credit utilization, length of credit history, 15%, which benefits from a longer borrowing record, credit mix, 10%, highlighting diversity in credit types, and new credit, 10%, where frequent new accounts can lower scores. Credit scores are calculated by bureaus like FICO and VantageScore, with FICO used by most lenders. Higher scores improve access to loans, lower interest rates, rental approvals, and even insurance premiums. Maintaining a good credit score is essential for financial stability and achieving favorable terms on credit. Staying proactive about managing these factors enhances your financial health and opens doors to better financial opportunities.
Ted, you mentioned before we went live that you wanted to be a sports announcer, but you love talking about credit scores and money because these are topics that touch all of us. Can you talk about how important our credit scores really are?
Your credit score is one of the most important numbers in your financial life. It goes a long way toward determining whether or not you're approved for loans and lines of credit, even many non-credit obligations like renting an apartment, getting a cell phone plan, signing up for utility service. In all those cases, if you have a low credit score, you could be denied or you could have to put up a higher deposit. Your credit score is super important, and it really is important for people to know this information, figure out how it's calculated, figure out how to improve it. It really touches a lot of aspects of our lives. And I would argue it's become even more important in the past few years as interest rates have gone up. We've seen record high credit card rates in recent years. You really want to put your best foot forward from a credit standpoint.
Yeah, I mean, we're all impacted by inflation and the rise of our expenses monthly. But it sounds like the credit score is like really hidden, can have a very big impact on the prices that we pay and the money that we spend.
It's a report card. It's basically your financial report card. It's meant to assess how likely you are to pay a lender back. And even a little bit of a difference can make a big difference on a product like a mortgage. Let's say 20 points different on your credit score, maybe that's worth, a quarter point or a half a point on a mortgage rate. Well, over 30 years, that might be tens of thousands of dollars. So that's just one illustration. But yeah, your credit score is a really important part of your financial life.
Chi-Chi, I've heard you talk about major credit reporting agencies are essentially a functional monopoly. Can you elaborate on how this affects all of us?
Yeah, absolutely. So this credit card for almost all consumers in the United States, it's not held by a public school or private school or the government. It's held by three corporations, Equifax, Experian, and TransUnion. And it's the data in those credit reports that gets fed into the computer models by FICO or VantageScore that spits out the three-digit credit score. Now, these three companies, they have all this financial data on us, but we are not the customers. Our data is the commodity. Their highest duty, these three companies, isn't to us. It's not even to the lenders or the public good. It's to shareholders. They're in it to make money. And what this means is that they trade in our data. We are not the customers. The lenders and the debt collectors that use the information are the customers. And so sometimes things go wrong. For example, there's a lot of inaccuracy in credit reports. The Federal Trade Commission did a big study about 10 years ago and found that 1 out of 5 consumers has a verified error in their credit report, and 1 out of 20 has an error so significant that it could cause them to be denied credit or to have to pay more for it. And 1 in 20 consumers is a lot when you're thinking about something as important as your financial report card. Like, we would not accept an error rate of 1 in 20 for other things. Like what if 1 in 20 planes fell out of the sky or 1 in 20 cars exploded spontaneously? That would not be good. So this error rate in credit reports is a huge problem, and it's hard to get those errors fixed. In fact, just yesterday, the Consumer Financial Protection Bureau actually sued one of these companies, Experian, for not having a proper system so that consumers can dispute and have errors fixed on their credit report.
How often do you check your credit report for errors?
So consumers should always check their credit reports for errors. I do at least once a year. And it used to be that you get one free report from each of the big 3 credit bureaus once a year. That's what you're entitled to under the law. But one of the good things they've actually done is they're making free reports available on a weekly basis. So, if once a year doesn't seem adequate to you, you can go to town and order once a week. Now, you're not going to see a lot of changes from week to week, but you should definitely order your report if you're about to engage in a big transaction. So you're going to apply for a mortgage, apply for a car loan, try to get an apartment or a job. Definitely check it before then to make sure that there are no errors.
Preston, how does credit enter the discussion that you have with clients? Are you trying to balance like credit as part of a discussion that goes with like financial literacy and emotional well-being when talking about money?
Oh, well, I'm trying to balance. Here's my Doc Rivers going on right now. It's like, well, KG, come down to the post. But with clients, I'm trying to combat misinformation. For example, some people don't even believe you need a credit score anymore, right? It's like, well, credit scores are irrelevant when you get to a certain level of income, high income or wealth. And that I say that's not true because as it was said already, credit scores are not just to use for lending, right? It's used for services and life insurance, a whole host of other services that we need in our life that is, very essential. I mean, and you have to have a lot of wealth. I mean, 10, 15, $20 million, something to this effect, to where you're having to borrow against your assets, like life insurance or a stock portfolio, in order to finance yourself. Other than that, right? And that still may not be optimal. Other than that, you need a credit score to signal that you're somebody good to access capital to. My goodness, right? So sometimes there are false narratives out there that must be, offset with good information.
I have noticed when talking to an insurance agent about my auto insurance, and I'm trying to like call and get my premiums down, credit score comes up. The agent's always saying, well, let me check your credit score. And, oh, okay, your credit score is good. Let me see what I can do. It's always this game. So, Rocky, I want to ask you, because as an immigrant who came to the United States with pretty humble beginnings, and you've built significant wealth in a generation, how do you view credit?
I think it's changed over the years. In the beginning, when you're first starting out, you need credit. And so you want to always have that good credit score. Again, as you talked about, as you build wealth, it becomes less important. But kind of like your conversation with the insurance agent, it's a reflection of the way you behave. And so for me, I don't worry about my credit score, but my behaviors automatically drive good credit scores because I believe I behave in a good financial way to be able to do that. And then also passing it down to your kids, as they're starting off life or they want to go rent apartments, get loans, buy cars, is helping them to establish good credit. And there's a lot of ways to do that as well. So I think there's an importance to it, but as you build wealth, it becomes less important, but still important.
Anyone else want to add to this topic of trying to understand credit?
Well, I would just say that, we've talked about how credit scores are used for non-credit things like insurance and getting an apartment. We don't necessarily agree that's a good thing. I mean, this credit scores were designed for one thing. Okay, FICO, the Consumer Financial Protection Bureau, actually said this. They're designed to predict the risk that you'll be 90 days late on a credit obligation within 2 years. Okay, they're not designed to tell whether you're a responsible person, because sometimes people have bad credit, not because they're irresponsible or a hot mess, but because bad things happen to them. They got sick. They lost their job. They got into an accident. And, then their credit may get messed up, but it's not a reflection of who they are. It's a reflection of what happened to them. And that really shouldn't be used for things like whether you get a roof over your head. It's really not a reflection of whether you're a moral good person as much as circumstances. And so we don't agree that they should be used for tenant screening or cell phones or insurance. There are a few states that prohibit the use of credit information for insurance, and we think that's the better approach.
It's a good point. But then we still have to work if the world is working the way it is, we do have to understand how the game is played, right?
Certainly, understanding how the game is played is important. And what you can do on an individual level to help your own score is important. But also remember that you, as a voter and a citizen of this country, also get a small say in what the rules are. So, for example, yesterday, the Consumer Financial Protection Bureau announced that they're going to ban medical debts from showing up on credit reports. That's huge. 5 million people are going to see better credit scores because of this. The rules got changed for the better because your credit shouldn't be ruined because you got sick. Unfortunately, we don't know if that rule is going to stick because of what's happening in our country. And so, it's, yes, you should do everything possible to get your own house in order and your credit good, but also understand that it's not a moral judgment. Okay. If someone has bad credit, it's not because they're a bad person.
So give yourself some grace. We're going to go to segment 2. We're going to talk about how to improve our credit scores.